If you do not know how money is created, then your whole life you will just chase money without ever being able to hold on to it. From a young age, we are taught how to earn money, but almost no one teaches us where money actually comes from. We work, get paid, save, and then keep chasing money every single day, while in the modern financial system, a huge amount of money can appear very quickly without any additional labor or goods. So who has the power to create that money? And how do those decisions affect our lives? In today's video, I'm going to answer that question for you. And to make it easier to picture, let us start with Bobo's story. Every day, Bobo still goes to work diligently, still trading his time, energy, and exhaustion for money. He believes that if he works more and saves more, life will gradually get better. But the problem is, while Bobo is trying hard to earn money, there is another system out there quietly creating money behind the scenes. Here, you need to understand the difference between earning money and creating money. Earning money is when Bobo sells a loaf of bread and gets $10 from a customer. That money is only moving from one person's pocket to another, and it does not increase the total amount of money in society. But creating money is different. It happens when the financial system injects new money into the economy, causing the money supply to grow without necessarily increasing goods or real value at the same pace. And what is the result? The money Bobo worked so hard to save can gradually lose value over time. In other words, Bobo is still working just as hard, but the money he is holding in his hand is no longer as powerful as it used to be. If we do not understand this, we may end up like Bobo, blaming ourselves and thinking we are not smart enough or hardworking enough. But the truth is, the value of money does not depend only on the effort it takes to earn it. It also depends on how the system creates more money and puts it into the economy. That is why, if you want to protect the value of the money you make, you first need to understand how money is created, who has the power to create it, and how the whole system works. So how is money actually created? The first way is physical money issued by the government. Picture a morning at Bobo's bakery. A customer hands him cash for a hot loaf of bread, and Bobo believes that bill represents the real value of his hard work mixing dough and baking bread. But the surprising truth is that physical cash makes up only a very small share of the total money supply, around 3% to 8%. In other words, most of the money in the economy does not exist as paper bills that Bobo can actually hold. And if everyone rushed to the bank to withdraw cash at the same time, the system would break down immediately, because there would never be enough paper money for everyone. So why does the government still print money if it is only a small part of the system? Mainly to support everyday purchases and to make sure automated teller machines have enough cash when workers like Bobo need to withdraw money to spend. Printing money also creates a huge profit for the state. For Bobo to make one loaf of bread, he has to spend time, effort, and money on ingredients. But printing a $100 bill costs only a tiny fraction of the value written on it. That gap between printing cost and face value is part of the profit the government earns from issuing money. At this point, Bobo starts to see the first path money takes into his life. Paper bills and coins are the most visible and easiest to use, but they are only a very small part of the whole monetary system. Inflation and the loss of purchasing power. Once Bobo realizes the government can create money so easily and make such a large profit, he starts wondering, why not just print a lot more money and give it to everyone, so nobody has to struggle anymore? It sounds reasonable, but more money does not mean more wealth. Inflation happens when the overall price of goods and services rises over time, which means the purchasing power of money falls. Put simply, with the same amount of money, Bobo can buy less than before. For example, if he makes 100 loaves of bread a day, bread keeps its value because the supply is limited. But if millions of extra loaves suddenly appeared everywhere while the number of buyers stayed the same, bread would no longer be as valuable. People would not pay as much for it. Money works the same way. When the amount of money in society grows too fast, but real goods like bread, clothes, gas, and housing do not increase with it, each dollar loses part of its value. Bobo may still hold the same amount of money, but he can buy less. That is inflation. When inflation gets severe, money can lose value very quickly. Then what Bobo saved after days of hard work no longer holds the value he expected. On the surface, he still has money. But in reality, that money keeps buying less and less. And when inflation gets out of control, a currency can collapse fast, as seen in countries like Argentina, Zimbabwe, and Venezuela. At that point, money no longer stores the value of labor. It slowly turns into paper with less and less meaning. There is also a major historical turning point that helps explain why today's system is so vulnerable to inflation. 1971. Before that, the global monetary system was still closely tied to gold, meaning governments could issue money only if they had enough gold in reserve. But after 1971, that link was completely broken. Money was no longer limited by a scarce asset and became based entirely on trust. That shift made the monetary system more flexible and easier to expand than ever before. And because money can now be created without hard backing, its value also becomes easier to dilute. After understanding this, Bobo realizes that even if he is holding cash in his hand, if the system keeps creating more money, then the real value of his savings is quietly being taken away. The second way, private banks create most of the money in the economy. After learning that the government prints only a small amount of physical cash, Bobo starts to wonder, where does the other 90% plus come from? The answer is private banks, the same places where Bobo deposits his paycheck. Put simply, most money today is not printed by the state. It is created by banks whenever they make loans. Let us go back to Bobo's bakery. Suppose he wants to expand his shop, so he goes to the bank and borrows $40,000. Many people assume the bank must already have that money in a vault, or that it takes someone else's deposit and hands it to Bobo. But in reality, once the loan is approved, the bank simply adds $40,000 to Bobo's account in its system. At that moment, new money appears and starts moving through the economy. Bobo uses it to pay contractors, buy a new oven, purchase flour, and cover wages. The people who receive that money then spend it on other things. That is how new money enters circulation through bank lending. At this point, Bobo begins to understand that banks do not just lend out existing money. They also create new money when they issue credit. That is why most money today exists as numbers in bank accounts, not as paper bills or coins Bobo can hold in his hand. This is why people say most of the modern money supply is digital money created by banks. Bobo now sees that money in this system is created only when someone borrows. That means when he borrows $40,000, the system gains $40,000 in new money. But when he repays the $40,000 principal, that money does not stay in the economy as freely circulating money. It is removed from the system. Only the interest he pays remains with the bank as profit, and that is where a major problem begins. The principal is created when the loan is made, then disappears when the loan is repaid. But the interest still has to be paid on top of that, so the economy constantly needs new money to keep going. And the only way to add new money is through new loans. In other words, for society to have more money, people, businesses, and even governments all have to keep borrowing more. That is why the modern economy works like a bicycle in motion. As long as people keep borrowing, it keeps moving. But if credit slows down too much, if people stop borrowing or try to pay off debt all at once, the flow of money shrinks, the economy loses momentum, and problems begin. The role of housing, deposits, and financial speculation. After learning that banks can create money through lending, Bobo asks another question. Where do banks most like to put that money? The answer is housing. For banks, mortgage lending is highly profitable and backed by collateral. If the borrower cannot repay, the bank can still take the house. That is why housing has become one of the biggest channels through which banks create new money in the economy. For example, when Bobo borrows money to buy a house, the bank creates new money and pushes it into the market. When many people do the same, more and more money flows into real estate. But the actual number of homes does not rise nearly as fast. As a result, home prices keep climbing. So banks do not just profit from loan interest. The credit they create also helps make housing more expensive. In the end, homebuyers like Bobo carry large debts for years, while banks receive steady interest payments and hold relatively safe collateral. Bobo should also understand that money deposited in a bank does not just sit still in a vault, the way many people imagine. When he puts money into the bank does not keep the whole amount waiting for him to come back and withdraw it. It keeps only part of it, and much of the rest can be lent out again. That mechanism helps banks expand credit and create more money in the economy. Put simply, from one base of deposits, the banking system can create multiple layers of new money through lending. But the story does not stop with housing. Banks do not just make loans and wait for interest payments. They also take part in more complex financial activity to chase bigger profits. Loans can be bundled together, turned into financial products, and then bought, sold, traded, and speculated on in the market. That means from one ordinary debt, like Bobo's home loan, the system can build many more layers of financial transactions on top of it. And the more layers it creates, the bigger the system looks, but the more fragile it becomes underneath. At first, money is created to serve real needs, like buying a house or expanding a business. But over time, some of that money gets pulled into financial speculation, where the goal is no longer creating real value in everyday life, but making profits from price swings and from stacked layers of financial paper. When that happens on too large a scale, the financial market starts growing faster than the real economy, and a system like that becomes highly vulnerable to crisis because it depends more and more on debt, leverage, and the belief that asset prices will keep rising forever. By this point, Bobo can see that in the eyes of banks, housing is a very efficient debt machine. Deposits are raw material for creating more credit, and financial speculation can circle back and affect Bobo's life through home prices, interest rates, and the stability of the entire economy. That is also the foundation that led to the system's next major collapse, the 2008 financial crisis. The 2008 crisis, and how the system had to save itself. When banks create money through debt, people can borrow to buy homes, cars, or speculate, making the economy look strong and fast-growing. But debt cannot grow forever. At some point, households and businesses owe so much that they can no longer pay the interest, and they cannot borrow more to cover old debt. That is when the system starts to stall. Confidence breaks down, asset prices fall, and huge debts suddenly turn into bad loans, bringing down the whole house of cards. The year 2008 became a turning point because many financial institutions had grown so large and so deeply tied to the credit system that if they were allowed to collapse, the damage would spread through the entire economy. That is where the idea of too big to fail came from. The United States government and the Federal Reserve had to step in with emergency measures to stop the financial system from collapsing in a chain reaction. They provided liquidity, rescued key institutions, cut interest rates sharply, and launched large-scale asset purchase programs. Put simply, the system had to save itself, because if it had not, the fall of major banks could have frozen credit, starved businesses of funding, pushed unemployment much higher, and driven the economy deeper into recession. The result was a badly distorted economy. To keep the system from collapsing again, central banks had to hold interest rates extremely low for a long time. Keeping rates near 0% was like giving cheap oxygen to a patient in critical condition. It flooded the market with cheap money, but that money did not truly flow into production. Instead, it kept circling through speculative channels. The economy Bobo lives in today is really being kept alive by a financial life support machine more than by a natural recovery. Once Bobo understands the significance of 2008, he realizes that when the usual ways of creating money stop working, this machine has to use an even more powerful weapon. The third way, central banks create money through quantitative easing. After private banks pumped too much money into the economy through debt and then got trapped in crises like 2008, a big question appears in Bobo's mind. Who steps in to save the whole system? The answer is the central bank. And this is where we come to the third way. Central banks create money through quantitative easing, or quantitative easing. This method is far more powerful and operates on a much larger scale than the first two methods. Bobo can think of it this way. When the economy starts running out of steam, cash becomes scarce, and banks can no longer support themselves. The central bank creates new money out of nothing and injects it into the system to keep it from collapsing. In the second method, commercial banks create money by lending to people like Bobo. But at this stage, the central bank creates money at the macro level to support the entire financial market. So how does a central bank do this? It does not print trucks full of paper money and hand it out on the street. Instead, it creates new digital money in its computer system, then uses that money to buy financial assets, most commonly government bonds, from commercial banks. Let us go back to Bobo's bakery to make this easier to picture. If a bank is holding Bobo's debt and running short on cash, the central bank steps in and creates huge sums digitally to buy that debt from the bank. As a result, Bobo's bank suddenly has a fresh supply of cash on its books, allowing it to keep operating and keep lending. That helps calm the market, pushes interest rates lower, and gives the whole system some breathing room. Bobo can picture quantitative easing as a machine running beyond its limit, starting to lose power and nearing a full shutdown. At that moment, the central bank acts like the operator who pumps in emergency energy so the machine can keep running. But that does not mean the core problems of the economy are gone. It only means the system has been given enough support to avoid collapsing right away. And Bobo also realizes that because quantitative easing money mostly exists in digital form and goes into banks, it does not flow straight into the pockets of workers. Instead, it often pours into asset markets like stocks and real estate, pushing their prices much higher. That is why quantitative easing is mainly a tool to save the financial system first, not a way to make ordinary people rich overnight. A major consequence: asset prices rise, and the wealth gap grows sharply. After learning how central banks pump trillions of dollars into the system, Bobo realizes that this huge amount of money is never shared equally. Instead, it creates an unfair effect where the rich keep getting richer, while honest workers like Bobo fall further behind. That happens because new money flows first into the connected vessels of finance: banks, hedge funds, and asset markets. When a massive amount of money pours in while goods and land remain limited, stock prices and home prices get pushed higher and higher. That is why even when the real economy is struggling, housing and stock markets can still soar, because money is rushing there for safety. This unfair pattern is called the cantillon effect. Bobo imagines new money like a bucket of dye poured into a tank of clear water. The people standing closest to the source, the financial elite and the wealthy, get that money first, before prices across the market have fully risen. They quickly use it to buy more land and more stocks at favorable prices. Meanwhile, Bobo is standing at the far end of the flow. By the time that money finally reaches him through wages, housing, gas, and food prices have already jumped. So Bobo has to spend the money he worked hard for on a life that has become much more expensive. This is exactly how the monetary system turns into a machine that widens the gap between rich and poor. The rich, because they already own assets, see their wealth rise rapidly without putting in more labor. They get richer even while they sleep. By contrast, workers who live only on wages fall into a trap with no easy way out. No matter how hard Bobo works, his yearly pay raises never catch up with the explosive rise in home prices. As a result, Bobo feels like a man running on a treadmill that keeps moving backward. The harder he runs, the farther financial freedom seems to get. The real value of his labor is being diluted every day by digital money that can be created out of nothing with incredible ease. That is the core of inequality in the modern financial system. So what is the solution? We can print money, but we can never print real prosperity. A central bank can create billions, even trillions of dollars, with just a few moves in the system. But it cannot instantly create more factories, more skilled engineers, more new technology, better job skills, or more real products in the world. A society becomes truly richer only when it creates more real value. That means more goods, better services, better technology, higher productivity, and a real improvement in people's daily lives. So the real question is where that money goes. If new money mostly flows into asset speculation and short-term financial games, it only drives prices higher without creating lasting value. But if capital is directed to the right places, it can create real growth. It should flow more strongly into small and medium-sized businesses because they create a huge number of jobs in the economy. When a small business gets more capital, it can expand, hire more workers, buy more equipment, improve its services, and generate real income in everyday life. Capital should also flow into education. Education does not produce instant profits like speculation, but it builds long-term strength for society. A better trained worker becomes more productive, adapts more easily, and can create more value in the future. On top of that, money needs to go into production, because production turns capital into real goods, real jobs, and real productivity. It should also go into innovation and research and development, because those are the places that create new technology, new methods, and long-term competitive strength for the economy. Investments like these are not as flashy as a sudden spike in stock prices, but they build the real foundation for lasting growth. So in the end, the right solution is to send money to the right places. Bobo can print another piece of paper with $100 written on it, but he cannot use that to create more bread, more ovens, more skills, or more customers. The economy works the same way. To become truly stronger, it has to create more real value, not just more money. And that is the path that should be prioritized if the real goal is to help society grow in a lasting way. Finally, I just want you to remember this. In a world where money can be created without limit, the only thing that truly helps us stay grounded is real value, built from productive work and real assets with lasting worth.